Good afternoon, everyone. On behalf of the National Energy Assistance Directors Association, I would like to welcome you to today's webinar on defining countable income in LIHEAP. This is the third webinar in a series for LIHEAP grantees presented by NIETA and the U.S. Department of Health and Human Services Administration for Children and Families. We have two speakers today, Lauren Christopher, Director of the Division of Energy Assistance, which is the office in ACF that runs LIHEAP, and second is Yulia Razad, who is a program analyst at the Division of Energy Assistance. Lauren will be presenting first, followed by Yulia, and at the end we will have a live question and answer session to get all of your burning questions answered. You may also submit questions through the chat function, though any questions submitted by chat will be answered at the end during the question and answer session. And with that, I would like to turn it over to Lauren so she can get started.
Thank you, Cass. And good afternoon to everyone, and good morning, depending on where you're located. So you may recall that we issued an information memorandum a few years ago, back in 2010, regarding exclusions from income when determining LIHEAP eligibility. We thought it'd be a good time to do a little refresher on that, and so I'll be walking through generally some of the different federal programs out there that might be resources that some of your clients are getting, but that should not be included in the income determination for LIHEAP. And then I'll be turning it over to Yulia to give us some examples of further areas that some grantees have chosen to flesh out in their income exclusion policies. So as you recall, again, with this being a block grant program, the federal LIHEAP statute and regulations do not actually define the term income. That is within the discretion of each of you. And so when we go out to on our monitoring reviews, part of what we will look for are your written policies and procedures and the training that you do for your intake staff regarding income, whether you're using gross income versus net income, and what you are including in the base income for determining the income eligibility for LIHEAP. Regardless of whether you're choosing to use gross or net income, again, that's your choice. Federal rules require that certain sources be excluded from the base income for LIHEAP income eligibility determinations. And we've given the link on this slide to this IM back from 2010 that goes into more details about this. So here is a kind of a broad overview of the different federal programs and other programs that should be excluded, must be excluded when you're considering LIHEAP income eligibility. SNAP, what used to be food stamps, WIC, the National School Lunch Program, tribal per capita payments up to $2,000, federal student aid, certain monetary allowances for children of Vietnam War veterans, and tax-exempt portions of payments under the Alaska Native Claims Settlement Act. I'm just going to walk through each of these and provide a little more detail, as well as the federal citation in case you need to follow up with further details about each of these programs. And I will also note that on our website and on the Clearinghouse website, there is a link to the Tribal Manual, and Section D of the Tribal Manual also goes into a very good explanation, detailed explanation about the different exclusions that must be in your policies and procedures and your training materials. And so regardless of it being the Tribal Manual or not, we recommend that as a resource to all LIHEAP coordinators for states, tribes, and territories. And so please check out Section D of the Tribal Manual as well for this topic. So regarding SNAP, the food stamps program, as you probably know, these are generally benefits that are given out by states. They are cash-like vouchers to provide low-income Americans with the ability to purchase food. The value of the SNAP benefit must be excluded from the income from the household members that are applying for LIHEAP. And we provided you with the link to the SNAP law that requires this being excluded from other federally assisted programs. The WIC program for supplemental nutrition for women, infants, and children, also administered by the U.S. Department of Agriculture, provides health care and nutrition services for low-income pregnant women, breastfeeding women, and infants and children under the age of 5. Again, it's a supplemental voucher that provides additional social services to these persons. These benefits must be excluded from the income for the household members for LIHEAP income eligibility determination. And again, here is the federal citation for that requirement. The National School Lunch Program. This is also related to the value of food commodities. This started way back in the 30s, I believe, to under Public Law 74-320 to provide in-kind food resources and benefits to low-income populations, and that eventually turned into the National School Lunch Program in part. Again, administered by the U.S. Department of Agriculture, in-kind food materials that are provided through schools, central kitchens, and caterers to provide free and discounted meals for students of low-income families. The value of the free or discounted lunch must be excluded from the income of the household applying for LIHEAP assistance. And again, here's a federal citation for that requirement. Tribal per capita payments, the first $2,000 for each member of the household that receives these per capita payments must be excluded from the household income for purposes of determining LIHEAP income eligibility. This includes payments out of income from tribal lands or tribal judgment, trust funds, and any source except gaming revenues. Again, here are the citations as well as our previous guidance on this topic in particular. Federal student aid. So grants or loans to undergraduate students made or insured under programs administered by the U.S. Department of Education must also be excluded from income for determining LIHEAP eligibility. Here are the various relevant federal sections on that. This includes the Basic Education Opportunity Grant, the Supplemental Education Opportunity Grant, the State Student Incentive Grant, the National Direct Student Loan, and the Guaranteed Student Loan programs. The Department of Veteran Affairs also provides monetary allowances that are based on the level of disability that children of Vietnam War veterans have. Any child of a Vietnam War veteran that was born with spina bifida qualifies, as well as children of female Vietnam War veterans that have certain birth defects qualify for these monetary allowances. Again, the amount depends on the degree of the disability, and this payment will continue when the children reach adulthood. So this may be an adult who is receiving this type of resource. This must be excluded from your income eligibility determination for LIHEAP. And again, we have a specific prior guidance on this as well as the federal citation requiring that. And lastly, the large one that will affect one state in particular is the Alaska Native Claims Settlement Act. And this requires that none of the cash, stock, partnership interest, land or interest in land, or in a settlement trust be counted as income for purposes of LIHEAP or other federal assisted programs relating to the Native corporations that receive these resources. And we provide the federal citation for this as well. And so now I'd like to turn it over to Yulia, who can walk us through some, aside from these federally required exclusions from your base income calculations, she's going to provide some examples of how different states and grantees have further defined their income policies for purposes of eligibility determinations. Yulia?
Thank you, Lauren. So there is a lot of discretion that each LIHEAP grantee has in determining policies for calculating and accounting income eligibility. And several topics come up time and time again, and we thought we would take this opportunity to go through a few of them and show examples of how various states have dealt with issues such as income from self-employment, other types of income exclusions that states choose to honor, treatment of seasonal employment and how to calculate income for those who are not employed year-round, and what to do with a household situation where there are roommates as opposed to boarders, where multiple people are sharing a home. So self-employment. In Wisconsin, requires income documentation for a 3-month period. And if you are self-employed, you're asked to provide your last 12 months of income with qualified deductions, and then that creates an average per month. You divide that number by 12, and you insert that into each of the 3 months that is required for the Wisconsin LIHEAP application. Alternatively, you can also provide a tax return. If you did not file a tax return, Wisconsin creates a special form that you can fill out, and you can see this form in their operations manual as well as their policies on how to calculate self-employment income, which is linked at the bottom of this slide. It looks like pages 34 and 35 of the manual address this topic specifically. In New York, applicants can choose between using their prior year tax return as an annualized income for the program, or provide documentation for their last 3 months of net profits from the business. And that information is used to then calculate a monthly income. So if you had lost money on the self-employment, then that income for that month would be counted as 0. So if you choose to provide the last 3 months of documentation, there's actually a very detailed list of documentation that you must provide. You need to provide business records. You need to provide receipts for income and expenses. You have to provide tax records for the quarter. And statements, signed statements from any employees that you paid as part of your business if you are self-employed. All of this information can be found in the New York HEAP manual, and you can see the link there with the appropriate page citations. Popular income exclusions. Although it is not required that these income sources be excluded from income when determining LIHEAP eligibility, many states choose to exclude things like income earned by minors or household members over the age of 18 who are still enrolled in high school, income received through the Earned Income Tax Credit, irregular cash gifts. So if, 1 month your parents gave you a gift of $500, that would not be counted because it's not a consistent amount of money that one receives time after time. And most grantees also exclude employer-paid fringe benefits like health insurance and contributions toward retirement accounts. Seasonal employment is another thing that many grantees struggle with in terms of how to quantify the value and how to count it appropriately. So we'll go through a couple examples of what other states are doing. Wisconsin asks for the last 12 months of seasonal employment and then divides that amount by 12 to get a monthly income amount that they use. If someone is working year-round and has an additional job that is seasonal, they are not considered seasonally employed, and the full value of the seasonal employment for whatever period they're applying for counts toward their eligibility determination in terms of income. And you can read about Wisconsin's policies in their manual on page 37. The situation with roommates and boarders is very interesting, and Oregon has a very unique approach where they actually distinguish between the concept of a roomer/boarder and the concept of a roommate. So in Oregon, a roomer or boarder is a person who rents a room or a section of the home from the building owner, but does not share in any of the common household expenses. And so that person would not be included in the household if the owner of the home was to apply for LIHEAP. However, that person would have to provide a written statement that says that they are not part of the economic unit of the home. On the other hand, a cohabitant or a roommate, which is a person who rents a room but also shares common spaces and shares in the utilities and other common household expenses of the home, is considered a member of the household, and their income would be included if the homeowner was to apply for LIHEAP, or the roommate, vice versa. So in most cases, if you are a roommate in Oregon, you are counted in the household. But if you are a boarder, you are not counted in the household. However, rent payments received by the owner of the home from a roomer or boarder are counted toward the income eligibility guidelines of the owner who is applying for LIHEAP. So if you do not have a roommate, but rather you have a boarder or roomer who is not part of your economic unit in the home, then any rent that you receive minus expenses from that roomer is counted as part of your income. You can read about those specific policies in the Oregon LIHEAP manual, which is linked below. Pennsylvania takes a different approach. Rather than counting all of the rental income minus expenses for a homeowner who rents a portion of the home, they only count 50% of the rent received by an owner when they rent part of their home to a roomer or a boarder. And if you want to read about Pennsylvania's policies, you could do so. Their manual is linked below here as well. There is a very extensive list of exclusions published by the Social Security Administration of types of income that are excluded under the SSI program. And if you'd like to read more about that, the link for that list of exclusions is on this slide. And we will be sharing these slides at the end of the presentation. And now we'll open the floor up to questions.
Hi, this is Kim Carver from Illinois, and I was wondering what type of documentation you use for the income tax proof. If they're going to use income tax, do you have something that's filled out by an accountant and been signed, or is it just the regular 1040 form that they've completed themselves?
Hi, Kim. This is Yulia. I think that policy is up to the state to determine. I would say that many people don't use accountants anymore to file their taxes. So as long as you had a 1040 that was signed by the client or the household member filing the taxes, and they had evidence that they submitted that tax return, that you could use that.
What type of evidence would you suggest?
In terms of proof of submission? Usually, if you submit online, you get some sort of certification.
Right.
You submitted it. Some people, when they submit by mail, get receipts. The IRS normally sends you something via email when they've received your submission.
Okay. I think that answers my question. Thank you.
But I want to say that, that particular policy would be up to you to define. It's not a requirement of federal LIHEAP statute or regulations that there per se be evidence that the tax return was actually submitted.
Sure, because I think that there's some kind of documentation that you have to ask for with the IRS that requires a payment, something that shows proof that they've sent in their taxes. But if if you're suggesting, or one of the suggestions is to have someone do their taxes online in one of those free tax sites, and they have confirmation, I think that would work too.
Yeah, I think so.
All right, thank you.
Okay. We have received a question through the chat function. Somebody is asking, how would a state go about determining the difference between regular veterans benefit versus benefits going to children of Vietnam vets?
Hi, this is Lauren. Thanks for the question. So there should be a benefit letter that would distinguish which type of assistance they're receiving. You can contact the local office of the Department of Veteran Affairs if the benefit letter is unclear, or if you need to confirm if this is a qualifying birth defect for certain kids. And so I'm trying to figure out how to give you the link through the chat function for the directory of local offices through the Veteran Affairs Department. If I can't do that, we'll certainly send that in a follow-up email after this webinar. And please feel free to add a follow-up question if I didn't fully answer your question.
Okay, I'm going to let the next person ask the question on the live Q&A.
Hi, this is Linda Walker with the Yakama Nation, and on the rumor borders, with the extended, we have situations with the extended family that they're not exactly paying rent, but what they're doing is they're going to pay the cable bill, or they're going to pay the water sewer bill, and because of the extenuating circumstances, they're in the household. So they're not actually contributing rent. So are they a boarder?
Hi, Linda. This is Yulia. So the LIHEAP statute actually defines the concept of a household as an economic unit. So people living together who are contributing financially to one another's, resources. So I think that's what you would need to go on to decide whether to include them or exclude them. They don't necessarily need to be paying rent, but if they're paying, like you were saying, the cable bill or the sewer bill or something like that, it seems to me that they would be part of the economic unit of the household overall.
Okay. And then if they have all moved in there because just because there is no more job and there's no more unemployment and there's no more anything, but they are still part of the household, but they're still living off of the primary household person. Yeah.
Right. So the question is, are they completely self-sufficient and walled off entirely from everybody else living in the home, or are they sharing in the household expenses or in the household income? So if they are providing everything for themselves and paying rent or paying some amount of money to stay there and, buying their own food, not sharing any common space, then perhaps that would be someone who is not part of the household's economic unit. But if they're staying there and, they're sharing food, they're watching the cable and,
right.
Whether or not they're contributing financially, depending on their ability, then to me that seems like they are part of the household economic unit and they would be counted in the household.
Okay. All right. Thanks.
Okay, we have no other questions in the queue for right now.
So we'll try to send a link out to the Veterans Affairs offices along with the slides when we send them out to everyone.
I'm going to close the question and answer. So it doesn't look like anybody else has any questions. But if you do have a question, send it to the chat and we'll get to you. And here one pops up. Actually, quite a few. The first one, if parents share custody of a child, can both parents claim the children?
This is Lauren. So I think the question was, if parents share custody of the child, can they both claim custody of the child? Again, we don't have any rules at the federal level regarding this, but generally what I've seen out in the field is that it's usually one or the other parent that has the opportunity to claim for the kids to try to avoid duplication of services. And there's also, I've seen a variation in terms of whether one excludes a portion of the child support payment or not for the custodial parent. Again, we don't have a requirement one way or the other how you treat that payment.
Okay, the next question. If a roommate pays the owner $700 a month, an example that was given, isn't the $700 counted twice for the household? First as a part of the roommate's income and then as income reported by the owner. So for the 3-month period, the combined total income is $2,100.
Yeah, I agree. I think if you are counting the roommate as part of the household and counting income of both the roommate and the owner, then you should not count the rent the roommate pays toward the owner's income, because you're already counting it as part of the roommate's income. But if you are counting the roommate as a separate household and not part of the owner's household, and it is the owner that's applying for LIHEAP, then yes, the rent that the roommate pays should be part of the owner's income. So that's basically, I've summarized Oregon's policy on the situation. So it depends on whether or not the roommate is part of the household or if you've determined that they're not part of the household.
We did get one more. Lauren and Yulia, do you want to answer one more question?
Sure.
Okay. One more on the chat. I would appreciate advice on how to count money received from annuities or trust funds. Some money placed in trust has restricted use. If the person doesn't have free access to request or use the funds, I don't think we count it as income.
So there's not a federal policy on how to count those funds, and I think what the questioner posed is a reasonable cutoff in terms of if the client has access to them, you should count them, and if they don't, then you shouldn't. That seems reasonable to me, but it would be a policy that each grantee would need to set for themselves.
Okay. Thank you very much, Lauren and Yulia, for joining us today.